Welcome back to We Get Macro. We're going to continue with our class about principles of macroeconomics, and today we're going to start talking about money and banking. As you know, this is a time of adjustment, and as you can see, we're upgrading the studio / office now. And yeah, this is how this is going to go. So I'm going to see how things are working for you guys, and we will adjust the class. But great feedback so far, and thank you for all of those who let me know about what they thought about the first videos and how the class is going for them. Okay. So let's move forward, and as always, feel free to always drop a comment with some questions or email me, of course, and I'll be able to know what's going on. So there's no such thing as a stupid question, as a wise man once told me. It's always an opportunity to learn, and I need you guys' feedback to be able to learn as well. This is a two-way go. So as I'm jumping into money and banking, which is actually one of my favorite topics, actually my favorite topic to teach about macroeconomics. As you guys know, this is what I do my research on. And in this chapter, pretty much, we're going to highlight a lot of the defining money and its functions. So we're going to talk about M1 and M2. We're going to talk about the role of banks, and we're going to talk about how banks create money. And we're also going to be able to explain then the functions of money, different types of money as well. We're going to be able to contrast them and explain their differences. We're going to further explain when we start on our financial system class, which was a very brief introduction of the financial system and financial institutions. And now we're going to really focus on depository institutions, learn about different types of depository institutions. Okay, what leads to more specifically, what causes those commercial banks, savings associations, and credit unions to fail. They're going to go more in depth than just saying that it's risky loans and some of the things that we mentioned on the previous videos. Okay, so we're going to finally understand how banks work, and we're going to finally understand a little bit more about their balance sheet. With maybe it's the first time that you're having contact with understanding a balance sheet, which is a type of financial statement for a bank. Okay, so yeah, let's keep moving forward. And as always, let me know if you guys have any questions. So why do we use money, right? That's a very, very important question. It's part of our life all the time. We use it for transactions. We use it for several different things, right? And let's understand, what is it, right? Is it only currency and coins that are money? And actually, if you look all the way back in history, no. Several other things have been used as money. We're going to define what that is and what functions those monetary assets have for an economy. Right, but for example, this cowrie shells, those are the first types of monies that come to mind. They were used a long time ago, right? But they're durable, they're uniform, so very, very hard to counterfeit. So people couldn't really make their own and then try to create their own money, right? So it was some type of limited supply, and that made it very valuable, right? And we understand what other factors also allow this instrument, this asset to be considered a monetary asset, right? So let's define money and its functions before we broaden out into different types of monetary assets. Okay, so it's crazy, right? Because money is really not anything. It's something crazy, because usually you think about something that you enjoy, that you want to accumulate, and yes, maybe you want to accumulate money, but you're truly happy when you actually part with it, right? When you actually spend it, which it's kind of what that quote from Ambrose Bierce. That's what she said, and that's true, right? It's a funny thing that we want money, so then we can get rid of it, of course, in a way where we would consume and benefit from it, right? But it's a very flexible concept, and as you can see, it depends on how depends on the functions of this asset, right? And so we can define what is money, and more importantly, I want you guys to know why did money rise in our society as something so important. Okay, so why not barter? So barter here would be when two people enter into an exchange, where if I produce good A and you produce good B, now if I want your good and you want my good, we can exchange good A for good B, right? For a fair amount that we get an agreement with, right? As you can see, it has some limitations there. So maybe money is what comes in and helps. So take a moment just to think about, why do you use money today? Mark down some notes, and this is one of those that we're going to discuss in our virtual class today. Okay. Okay, awesome. Hopefully you had some time to think about it and wrote some notes down about why is money important, why we use it, and we can move forward with our class now by actually further describing exactly what we were talking about earlier, the proposed discussion. So why not barter? Let's start with that, right? Well, barter is literally trading one good or service for another, like I said. And the big problem is that you need to find somebody that not only is producing what you want, but that also wants what you produce, right? As you can see here on the little cartoon, you can see somebody saying, hey, I'll give shoes for a new hammer, but there's nobody selling hammers, so how can he acquire that hammer, right? So at that point, it gets really tough, and this is what we call the double coincidence of wants. That's a problem that can arise given barter, right? So a situation where two people each want the exact same thing that the other one is producing. If we don't have that, if we cannot find that, then we have the problem of the double coincidence of wants, which doesn't happen, okay? So barter is really difficult to make people get into contracts, especially when you think about the type of society we have, right? Not only we are trading for goods and services right now, but we're trading for future consumption as well, right? Loans, think about things like that. How would we do without money in that case? It'd be loans based on just goods and services, right? It gets really confusing when you think that way, right? And then since we're not bartering, it helps a lot to have something that is agreed upon everybody to be used as a medium of exchange, right? More importantly, you're going to see me talk a lot about this. Why do we use the dollar, right? One thing that it counts a lot is that it's a legal tender, right? Government stated that the coins and banknotes that we have, in this case, the dollar, they must be used, they must be accepted as type of payment for debts, public charges, taxes, and all dues, right? So because it becomes accepted by government, why then would we make transactions with another type of money to then exchange it for the dollar to pay the government? So eventually become a lot easier for all of us to just agree that the dollar is going to be the commonly traded monetary asset as a medium of exchange in the US economy, right? So money has some qualities, some characteristics that are different from other ones, right? I want to highlight specifically that money is not only dollars, pesos, and other types of international currencies, okay? Money can be different things. So for example, you can feel free to go and watch this video. You see the source down here. And this video is going to talk about when ramen noodles are used as money in prisons, right? So why could a ramen noodle be used as money in a prison? Or back in the day, during periods of hyperinflation, which we talked about before as well, right? Why would in Russia, vodka be used as a type of money? What kind of characteristics in common those things have with money that allows them to have to behave as such as one? Okay, so let's dive into that. The four functions we're going to dive a lot into is the first one is work as a medium of exchange, right? We're going to dive into them as the ability to be able to exchange a good for a service using a different type of asset, right? So in this case, I want to buy, if I want to go to the grocery store today and buy food, right? I have money, which works as a medium of exchange between me and the seller, right? So as you can see, it kind of leads to the second point, which is a deferred method of payment. Not only has to be able to exchange goods and services for it, right? More, it has to be accepted. Otherwise, what's the value of me paying that grocery store $10 if nobody else is accepting the $10? Right, so something to think about. And as you can see, there's other two characteristics that play a big role, which is being a unit of account. So we can count, right? $1, $2, $3, $4. Not only that, we can divide that into cents, right? So it's very countable. And does it hold value over time? Can we believe that later on we can use the same instrument, the same asset, monetary asset, to be used in transactions, right? So we kind of already described a little bit of them, and you see in the PowerPoints before to describe them. So medium of exchange is how we pay for goods and services today, right? So it's an intermediary, it's a middleman between buyers and sellers. So now we don't have to depend on that double coincidence of wants to engage in a transaction. Rather, we can agree that, hey, I have money, you're trying to sell something, and I know if you accept my money, you'll be able to buy more things later on, right? So that's important. So that's the first one. And of course, this connects, like I said, to the third method of payment. Not only you want to be able to pay, you want to, if you're a seller and you're accepting that payment, it really matters for you whether or not you can use that for future purchases, right? So being a deferred method of payment across sellers is extremely important, right? So not only that, but loans, right? Think about loans as well, right? If you're getting a loan and you're expecting, if you're lending money out to somebody, for example, and you're expecting to get paid back later on, you expect that money to be worth an amount at least relatively similar to what you expected when you engage in that transaction, right? And that's the deferred method of payment, that you still expect the dollar to be used later on in transactions, just like it is today, and that's why you accept to get paid in dollars later on. Okay. Money in your account, like I said, you can count money. So this is being able to count the units of the money. Like I said, a very simple characteristic. And the last one, which I want to point out, that money does have this characteristic, but in the way society is today and the way the economy has developed, this is not the best way to store value, right? But it's still done through monetary units, right? So if you think about it, this is a very, very blunt example, but is fruit a good, vegetables a good store of value? No, right? Because they're perishable, right? So you know that over time they would lose their value, they would go bad, right? So it's important that the value of money holds time, the value of money holds over time. So then we know that we can make similar purchases with it later on. Now we know that there's inflation already, right? And that's why it's not a perfect store of value, because we know that since we expect inflation, which causes the purchasing power of money, of that currency to go down, we know that's not going to be a perfect store of value, but there's instruments that use these monetary assets which we can use to better store value, to make our wealth store value better over time, right? Such as we talked about stocks, which are risky, but they can do that function. Bonds, a little bit more secure in terms of the expected return, right? But at the same time, a little bit more restrictions in terms of when you get that money back. And we talk about savings account as well, which is a less returns even, maybe less, you can think about a little bit less restriction or definitely less restrictions than bonds, right? So you know that this definitely plays a role in defining what money is, right? Not only that, we're going to talk about different types of money, right? Different forms of money, okay? So now that we know the four main functions of money, and we can then identify what is considered money in a society, what types of money do we have, right? There's different types of money based on our history, on historical economic facts. So for example, if you look at all the way back, the first type of money you're going to see is going to be the commodity money, right? So this is money that is actually a physical commodity. So like gold coins, silver coins, right? You can see that the value comes literally from what that coin is made, right? From the material, from that commodity itself, right? The second, the evolution of that was then that, hey, maybe it's not very useful to carry all those heavy gold coins with us all the time, right? So maybe we can make it better. Maybe we can make it a little more secure. And eventually, as the economy evolved, we were able to develop commodity-backed money. So what does that mean? Well, that means that that money that you have, that dollar bill, can be exchanged for in a fixed rate for a certain commodity, right? So it's kind of matched with the value. It's backed up by the value of a commodity. So such as the gold standard that we had in the US. That meant that the value of the dollar was pretty much pegged, dependent upon the value of the gold and how much gold the US had. Okay, and as you can see, those are things that maybe you haven't heard a lot about before, especially because of our age, right? But the one that we are really experiencing a lot in our society today, and it should be very, very clear to you, is the fiat money. Okay, so what is the difference between fiat money and the other two other monies? Fiat money has no intrinsic value. What do I mean by that? The value of the cost of producing $1 bill is not actually the value of $1 bill, right? It costs a lot less than $1 to produce $1 bill. But we still see the value of the dollar as higher than its cost of production. So where does that valuation come from? It simply comes from the belief that society has that it's worth $1, right? This is why when we talk about inflation expectations, we talk about the purchasing power of a currency changing so much based on the demand and supply for that currency, based on the expectations about society, about that currency, right? Then you know that now it's even more clear now that our belief about how much a currency is worth is actually what determines the valuation for that currency, okay? Which comes from interaction of the demand and supply market, okay? So the fiat money is actually the money that we experience the most, that we see in our lives today, okay? And like I said, its value pretty much comes from the belief that's gonna be able to have all those functions that we talked about before, not only today but moving forward, which is connected with the characteristic of being a legal tender, right? Which in case of the US and the dollar, like I said, the US states that the US dollar is a legal tender, which means you can pay for that, taxes, dues, and such things like that. Okay, just an example before I close this video due to the time, and I'll continue on the next one. Just to show you guys a quick example. As you can see here, you can differentiate the two coins, right? So if you look into the commodity-backed money, you can see it says it's a silver certificate, right? So this is a commodity-backed money. It's dependent on the value of the commodity silver versus what we have today, right? And it literally says on the note, this note is a legal tender for all debts and public-private. Okay, so you can see that that's the fiat money. And we'll continue with this video, with this class on the next video. Okay, thanks for watching.